All right, let's get straight to it. The board is set, and we're tracking a critical rotation in the AI sector. The mission today is simple: identify where the smart money is moving before the mainstream catches on. This is the AI handover. Answer first, always. The AI trade is rotating. Capital is flowing out of the infrastructure builders, the upstream, and it's moving into the application layer, the downstream. This heat map you're seeing from the Korean close, that's not just market noise. That's the signal. This is our new vector. So what we're witnessing here is a fundamental handover of leadership within the entire AI value chain. And look, this isn't a guess. The data coming out of Asia's tech-heavy markets, it's like a canary in the coal mine. It's a critical leading indicator for where capital is going to flow when the US market opens. Now, this contrast is absolutely critical. On the left, you've got the upstream. We're talking high-bandwidth memory chips, the raw compute power that built this whole AI boom. On the right, you've got the downstream, the robotics, the enterprise software, the stuff that actually uses all that power. For the last year, all the money, and I mean all of it, flowed to the left. That flow is now reversing. In Seoul, they actually have a term for this: judo guanyang. We'd call it the handover of leadership. It's a known pattern over there because in their hyper-competitive tech world, these shifts happen fast and they happen hard. It's that moment the baton officially passes from the builders to the deployers. So first, let's just establish a baseline here. To really understand how big of a deal this new regime is, we have to analyze the old one we're leaving behind. And the old regime was dead simple. For the past 12 months, the market had a one-track mind: AI infrastructure. Capital just flooded into the companies making the picks and shovels, the foundational hardware. That was it. That was the only trade that mattered. But then an anomaly popped up on our radar, a signal from the Seoul close that it deviated from the established pattern, and this is exactly where our focus needs to sharpen. The key data point is this number, 4.7%. That was the record surge in the KOSDAQ index. A number like that isn't just random market drift, that's a targeted capital injection. This is our primary evidence. And let's be crystal clear, this wasn't some broad risk-on party where everything went up. While the main index was strong, that 4.7% anomaly was highly concentrated. It was a precision strike into very specific downstream sectors: factory automation, autonomous logistics, and enterprise AI software. So the crucial point is this: the market is finally pricing in the answer to the single biggest question for investors. After a year of building all this infrastructure, is anyone actually making real money with it? Well, the signal from Korea is screaming yes, and capital is now chasing the source of those profits. Okay, let's get into the logic behind this move. Because it's not just about the amount of money moving, it's about the quality of that money. That's what separates a real, sustainable trend from just another short-term speculative bubble. There's this key concept called capital absorption capacity. It sounds a little academic, but it's simple. Can a sector take a fire hose of cash and turn it into real growth, not just an inflated stock price? The downstream AI sector is being tested on this right now, and the early results look good. And this is exactly why this signal is different. We're not seeing purely speculative, hype-driven capital here. We are seeing strategic capital. When a major player like Samsung makes a direct investment into a key supply chain node for robotics or for AI software, well, that's high-quality fuel. It's a validation that justifies a much higher valuation. So how do we translate this signal into an actual, actionable framework for the US market? It means we have to update our metrics. We need a new bridge to get us from the Asian close to the US open. Historically, the tech cycle has always been clear. First, you spend a fortune to build the hardware. Then, much later, the software applications start to make money off of it. There's always been a lag. The signal we're seeing today tells us that gap, that lag, it's closing much, much faster than anyone expected. The monetization phase is here. This means our whole analytical toolkit has to evolve. The old guard metric was hardware utilization, basically how busy are the chip-making machines. The new leading indicator is application monetization. What is the average revenue per user, the ARPU, for the software running on all that hardware? This isn't just a new metric. It is a whole new battlefield. So let's summarize and lock in the vector. The operational logic for how to invest in AI has officially shifted. The primary takeaway is this: the debate about if AI is profitable is over. That was last year's fight. The critical question right now is, where in the AI value chain is your capital deployed? The battlefield has moved. So, as you get ready for the market open, here is the final thought. Your capital is deployed, I know, but is it still aimed at the old target, the infrastructure? Or have you retasked it to the new, confirmed target, the profitable application? Because the handover is happening right now. Briefing complete, the vector is locked, execute.